It is Wednesday, January 21st, 2026. Welcome back to Talk Tickers, the deep dive where we stop pretending that corporate synergy means anything and strictly focus on the numbers.
The numbers that actually move the needles for your portfolio.
Exactly. I'm your host, and today we are dissecting the Q4 2025 earnings call from Zions Bancorporation's Zion, which dropped yesterday evening.
It's good to be here. And look, if you've been watching the regional banking sector at all, you know the vibe has been, well, tense.
Tense is a good word for it.
Yeah, I mean, the whole narrative is dominated by margin compression, deposit flight, and everyone just waiting for the other shoe to drop on commercial real estate.
It feels like the market has its finger just hovering over the sell button for the entire sector, just waiting for any excuse.
Exactly. And that is why this Zions print is so fascinating. It was a classic, and I mean a classic head fake.
Okay, explain that. What happened?
You saw the print hit the tape in after-hours trading, and the stock immediately, it knee-jerked down almost a full percent. It looked like the algos were ready to punish them.
But the punishment didn't stick.
Not at all. The sun came up, the human analysts actually read the transcript, and we saw just a violent reversal. The stock rallied over 4.4% the next day.
Wow.
Yeah, hitting highs we haven't seen in a while. It got up near $61.62.
So that kind of price action, that usually signals that the headline numbers were hiding something good. The market initially saw noise, but then it found the signal.
That's the perfect way to put it. The signal was a back-to-basics profitability engine that is finally firing on all cylinders. But to really get it, we have to look past the messy headline EPS.
Okay, let's start with the basics then, the lightning round, if you will. What did they actually report? Because usually beating expectations is a pretty low bar in banking.
Right. But this was a legitimate beat, top line and bottom line. So GAAP earnings per share, it came in at 1.76.
$1.76, and the consensus was what?
The consensus on the street was sitting at $1.57.
That's a 12% beat.
Yeah.
I mean, in the banking world, where estimates are usually dialed in pretty tight, a double-digit beat is significant.
It really is. And the revenue backed it up. They clocked in at $879 million, which beat the street's roughly $865 million expectation. That's up 7.1% year over year.
And net income
jumped significantly, $262 million, and you compare that to $200 million this time last year.
Okay, so they made more money than expected, but we know banks can manufacture EPS beats, right? You release some reserves, find a one-time tax credit. Was this a high-quality beat, or was it just accounting gymnastics?
That is the right question to ask, and there was definitely some noise in there. If you just looked at the $1.76, you might miss the mechanics.
So management walked through it.
They did, yeah. They actually gave us a bridge to get to the core earnings because there were moving parts on both sides.
All right, so walk us through that bridge. What dragged it down and what propped it up?
First, you had a headwind, but it was sort of a self-inflicted one. They made a $15 million charitable donation to their foundation.
A $15 million donation?
Yep. They said it was for tax planning purposes. That hit earnings by about 8 cents per share.
Hold on. So they gave away $15 million. I know it's charity, which is great, but from a pure shareholder perspective, that's 8 cents of EPS just gone. Why do that in Q4?
It's a pretty standard move for banks having a good year. You pull that giving forward to lower your taxable income. It's an expense now, but it buys you goodwill and, tax efficiency. So analysts tend to add that back mentally.
Okay, so that drags the number down. What lifted it?
Tailwinds came from the regulators. They got a nice benefit from an FDIC special assessment refund.
Getting money back from the insurance fund.
Exactly. And they had some gains in their SBIC portfolio, that small business investment company. Those two things combined added about 11 cents per share.
So you lose 8 cents to charity, you gain 11 cents from the FDIC and investments. It's almost a wash.
Pretty close.
Yeah.
A little positive.
Yeah.
So if you strip all that out, the charity and the refund, to see how the actual bank performed, you're looking at an implied core EPS of roughly $1.73.
Which is still crushing the $1.57 estimate.
Correct. So whether you look at the GAAP number or the core number, the business just plain outperformed.
Let's get into the engine room then. For a regional bank, the holy grail is the net interest margin, or NIM, the spread. Given where rates are, I'm assuming that's under pressure.
You would assume that, and you'd be dead wrong. This was the star of the show, and honestly, the main reason the stock ripped higher, NIM landed at 3.31%.
331. Put that in context for us. Is that good for Zions?
It's incredible. This is the 8th consecutive quarter of NIM expansion.
The 8th.
8th. Think about the volatility we've had in rates for the last 2 years. For a bank to expand its margin consistently for 2 straight years in this environment, that is what investors were paying up for.
Okay, but how? I mean, how are they doing that? The narrative is that banks are fighting tooth and nail for deposits. You see ads everywhere for 5% savings accounts. Their margins should be getting crushed.
That's the magic trick. They aren't paying that on everything. It all comes down to the liability side of the balance sheet. In Q4, they just aggressively remixed their funding.
Remixed how?
They cut their reliance on expensive short-term borrowings. We're talking about a $653 million reduction. That's a 17% drop in that high-cost funding.
And they replaced it with what? You can't just lend money you don't have.
They replaced it with customer deposits.
Hmm.
Good old-fashioned customer deposits. They grew around 9% annualized.
Hmm.
But here's the kicker, and this is the data point that probably made the short sweat.
Okay.
The total cost of their deposits actually declined.
Wait, they grew deposits, but the cost went down. That defies gravity right now. Usually to get growth, you have to pay up.
It dropped 11 basis points sequentially, down to 1.56%.
1.56% total cost of deposits in this rate environment? How?
Execution, pure execution. Management highlighted a very specific success. They migrated a huge chunk of funds from a consumer interest-bearing product into a new non-interest-bearing product.
They moved money from expensive to free.
That's it. We were talking about an approximate $1 billion migration. That is $1 billion of funding that suddenly cost the bank zero.
That is massive. That's just pure margin expansion. But looking forward, the Fed is probably going to cut rates eventually. Doesn't that hurt them?
It depends on how you're positioned. And Zion's guidance, it actually assumes 2 25 basis point Fed cuts in 2026.
Okay, one in June, one in September, I think they said.
That's right. And they said they're positioned as liability sensitive.
Liability sensitive. Explain that for the non-CFOs listening.
It means that when rates fall, their costs, what they pay you on your deposits, fall faster than their income from loans. So even though they earn a little less on loans, they save way more what they're paying out. The margin actually gets wider.
So they actually want the cuts in a weird way.
They certainly aren't afraid of them. It's how you defend the margin.
Okay, margin story is solid. Let's flip to the other side. Expenses. You can't cut your way to growth, but you also can't let spending run wild. I noticed they were talking about spending more on marketing and tech.
Yeah, but this is where the thesis gets really interesting for 2026. They are targeting what they call positive operating leverage.
Let's break that down. Positive operating leverage. It sounds like something from a corporate bingo card. What does it actually mean for me as a shareholder?
It's simple math, but it's incredibly hard to do. It just means your revenue grows faster than your expenses.
Okay.
Specifically, Zions is targeting revenue to outpace expenses by 100 to 150 basis points.
Yeah.
So if expenses go up 2%, revenue needs to go up 3.5%.
Which creates a widening profit margin. I get it.
Right. But to your point, they are spending. They explicitly mention more marketing spend to drive that small business growth and heavy investment in tech and AI.
What kind of AI? Is this just slapping a chatbot on the website, or is it real? Because every company says AI on their earnings call now.
It sounds structural. They mention fraud detection, product recommendation engines, and this one is key for a commercial bank automated financial statement spreading.
Spreading financials. That's the grunt work of banking, isn't it?
It is the absolute trenches. It's taking a borrower's tax returns and PDFs and manually typing them into the bank system to analyze risk. It's slow, it's expensive, and it's prone to human error.
And usually done by an army of junior analysts.
Exactly. If you can automate that with AI, you speed up loan decisions from days to hours, and you don't need that army of manual labor.
Which would explain the headcount numbers I saw?
It does. They are doing more with fewer people. If you look, FTE's full-time equivalents are down from a peak of about 10,300 in 2019 to below 9,300 now. That's 1,000 fewer salaries.
That is a huge reduction. And is it just firings, or is it changing how the work gets done?
It's a mix. Attrition, tech, and outsourcing. You mentioned they're moving their outsourcing from like 3%, which is way below peers, to closer to the industry average of 10 to 15%.
Okay.
Then they have about $40 million in savings initiatives baked into their guidance just to offset those new investments in AI and marketing.
So they're swapping back office headcount for AI and marketing dollars, cutting fat to feed muscle.
That's a great way to put it. And it is feeding specific muscles. Their Small Business Administration, or SBA 7A loans, nearly doubled in number. Dollars produced were up 53%.
53% growth in SBA lending is no joke. That's high-yielding paper.
It is. And on the commercial side, growth is C&I commercial and industrial and owner-occupied real estate. Geographically, they called out Texas, California, and the Pacific Northwest.
You mentioned commercial real estate. We have to address the elephant in the room. You can't talk about a regional bank without talking about CRE. What did Zions say?
The data really contradicts the fear here. Their CRE portfolio is about $13.4 billion, which is 22% of their loans. But look at the performance. Classified CRE loans, the risky ones, actually decreased by $132 million.
They went down. The narrative is that credit quality is falling apart everywhere, but their problem loans decreased.
They went down. And management expects that to continue declining through payoffs and upgrades.
That's encouraging. But I did see that slight uptick in C&I classifieds. Is that a warning sign?
It's worth watching, but management called it nothing chunky. C&I classifieds rose by $92 million, but they described it as broad-based economic friction. Not one big company blowing up.
So the overall risk profile is boring.
Boring is beautiful in banking. Net charge-offs were 5 basis points. 0.05%, basically non-existent. And they have a huge safety net, 215% reserve coverage on non-accrual loans.
Meaning for every dollar of bad loans, they have $2.15 sitting in the vault.
Exactly. It's a fortress balance sheet.
Okay, fortress balance sheet, growing margins, efficient ops. Let's talk about the shareholders. We love buybacks. What's the signal?
The capital build is just undeniable. Their CET1 ratio is at 11.5%, up from 10.9% a year ago. But the number that really jumps out is tangible book value, TBV. It's up 21% year over year.
21% growth in book value. That is compounding at a serious clip.
This is the third straight year of over 20% TBV growth. That creates a lot of optionality. They have excess capital.
So are they going to give it back to us? Because hoarding capital is great for safety, but it kills your ROE. What was the quote from the call?
Management was pretty explicit. They said they are nearing the point of increasing capital returns.
Nearing the point.
Yep. And when they were pressed on the timeline, the answer was probably this year, with buybacks likely accelerating in the second half of 2026.
Second half of 2026. So they're teasing it. Wait 6 months, then the party starts.
It gives them a buffer.
Yeah.
But interestingly, they really downplayed M&A. They said acquisitions are not a day-to-day focus. They're not looking to get bigger just for the sake of it.
Which makes sense. Why dilute yourself to buy someone else's problems when you're growing your own book value at 20%?
Precisely. They're happy to grow organically.
All right, we've looked at the past, we've looked at the present. Now let's look at the future. It is time for our This Is Not Financial Advice segment.
And the standard disclaimer applies. This is for entertainment purposes only. Do your own diligence. We are just two voices on a podcast.
But if you were a hedge fund analyst pitching to your committee right now based on this call, what's the trade? Because just buying the stock after a 4% pop feels like chasing.
I'm pitching the Zions 2H acceleration spread.
The acceleration spread sounds fancy. Break it down.
Okay, the setup is this. The market is pricing Zions like a standard regional bank. It's tied to the sector. If the sector goes down, Zions goes down.
Right. It trades with the basket.
But management just signaled a very specific idiosyncratic catalyst, something unique to them. Accelerated buybacks in the second half of the year, plus that positive operating leverage.
So how do we play that?
You go long Zion, January 2027 calls. You want EPS. You need the time. You want to be holding that exposure when the buyback machine really turns on in Q3 and Q4.
Okay, betting on the pop later in the year. But what about the risks? What if the Fed spooks the market? What if there's a recession?
That's why it's a spread. You have to hedge out that sector risk. So against those long Zions calls, you short the KRE, the regional banking ETF.
The pair trade. Long the winner, short the basket.
Exactly. By shorting the KRE, you're stripping out the sector, beta, all that rate risk, the general CRE panic. You are isolating the alpha from Zion's specific story.
Walk me through it. If the whole sector drops 10%, Zions probably drops 2%. How do you make money?
If the sector drops 10%, your short KRE makes you 10%. Zions, because of its better margins and the buyback coming, might only drop 2 or 3%. So you make more on the short than you lose on the long.
And if the whole sector rallies?
If the sector rallies, you expect Zions to rally harder and faster because of that positive operating leverage. You profit as long as Zions simply outperforms its peer group.
And given their extending NI and that expense discipline, the data suggests they should outperform.
That's the whole thesis. You're betting on Zions being a better operator than the average bank in that ETF.
It's a sophisticated play, but it fits the data perfectly.
It's the smart way to play the earnings beat without getting wrecked by a macro headline.
There you have it. To recap, Zions delivered a double beat, expanded margins for the 8th straight quarter, and promised a capital return party in the second half of the year.
And at the end of the day, in a noisy world, Tangible book value growth of 21% speaks louder than pretty much anything else. That is real value creation.
Absolutely. Thanks for tuning in to Talk Tickers. Remember to do your own research, and we'll catch you on the next deep dive.
See you next time.